major announcements from India's largest engineering conglomerate, Larsen and Toubro, came in yesterday on May 10th. First, their financial result for the quarter ended FY23, and second, a change in leadership. Now, to know more about this, we have the Chief Financial Officer of Larsen and Toubro, Mr. R. Shankar Raman, joining us. I'm Rachita Prasad, and you're watching Money Control. Welcome to Money Control, Mr. Shankar Raman.
Thank you.
Mr. Raman, very interesting set of numbers for the year that ended in March. Your revenue has grown 17%, profits are up 12%, order inflow is up 19%. You have managed to, match the guidance that you had given at the beginning of the year. But on one account, you didn't really match the guidance, which is on margins. There has been a squeeze on margins. Help me understand how the year panned out and what really was the challenge here, which is reflecting in the margins.
Sure. I think thank you for raising this, because this has been bothering a lot of people as to whether the company is under stress insofar as margin accrual is concerned. I think it's important to understand the breakup of this because much of the revenue that we have reported, 1,83,000 crores, that portion of which that comes out of the project business is been executing jobs that we have won in FY21 and FY22. And these were unique periods in the sense that the jobs were given, but the costs at which we were to procure material and equipments actually skyrocketed. And also, these were given at a time when the post-COVID recovery was not really complete. There were interruptions, both in terms of supply chain, shipping goods, labor availability, of the kind that is required to execute the project. The client's preparedness to open up his own facilities for us to execute the project. So the first casualty in all of this was time. We lost close to a year waiting for things to return to normalcy so that we could work to our plan. Kindly enough, the clients quickly agreed on time extensions. So we avoided the prospect of any liquidated damages that would come and cause harm to our P&L. But what we had to do was to maintain the site as mobilized. In fact, invest a little more, making sure it is safe and secure environment for people to stay and wait for necessary clearances. So consequently, the additional cost that we incurred of keeping the site alive and waiting for clearances to come is embedded in this margin erosion. The second part of it is when the sites became available for us to work, we had to actually place orders and start procuring goods and equipment for us to complete the projects. Now, by then, I think COVID became a worldwide phenomena, and to complement this, the war also broke out in Europe, which actually threw the supply chain out of gear. And even if the vendors were ready, the shipping lines were not available, and there was whole lots of logistics issues that actually delayed the receipt of material. And in the meanwhile, the prices kept going up. In fact, the prices went up to an extent where 25 to 75% was the order of magnitude increase in some of the prices of underlying material or equipments that were dependent on them. Now, we had to deal with all of this. The ultimate objective of the company was to make sure that we deliver to the revised timeline that the client has agreed. That meant that we had to catch up on execution, which is what is evident in FY23. As against a guidance of 12 to 15%, we actually ended the year with a revenue growth of 17%. And these percentages are on large basis. So I think that is reflective of the fact that we put more resources to make sure we make up for the lost time. Much of the cost we have accounted for in FY23 is a result of this inflationary input cost. We do think that the orders that we have won in FY23, which is almost 2,13,000 crores, have been procured on better terms. And in any case, the environment on supply chain is far more predictable today as compared to the period that was in 21 and 22. The softening of the material prices has been what was behind people expecting our margins to be met. but the softening of the material price have happened in the last 6 months. And what we have reported in our numbers are not necessarily what we have committed to procure in the last 6 months. These are commitments and procurements made out of the past years. So consequently, the cost has been accounted, done with, margin hit has been taken. The projects need to be completed. I do believe that it will take possibly 2 or 3 more quarters for all of these commitments to get completed, for us to sit across the client and start discussing about price variations. Contractually, there are many contracts which have this permitted as a price variation formula. We need to translate this into actual numbers, support them with data, and make our respective claims. But this is an ongoing process in project business anyway. So this will happen over a period of 12 months after the project gets completed. So you will see the softness of the margin that we have reported in FY23 play out definitely during the first half of the current year as well, FY24. Things will begin to turn trajectory as we complete our past commitments during Q3 or Q4 of FY24. So I see 24-25 to be a more normalized year where the margins with which we bid for a project is close to being achieved without this kind of disruption. Of course, I'm making a big prediction that nothing destabilizing or black swan event will happen in 24-25. But keeping that aside, I do think that the worst in terms of absorbing the cost for the past obligations are by and large done with.
It's heartening to know that the new orders that you have won, and so many of them are on better terms than before. Interesting thing that you said was that 24-25 would be a more normal year. Now, when I'm looking at the guidance that you have given for the next financial year, 23-24, at the current financial year, in terms of order revenue and orders and revenue. Help me understand, are you being a little conservative because you have given a guidance of 12 to 15% revenue growth and order growth of 10 to 12%? Is that to factor in the challenges that you are seeing in this financial year?
No, there are two different dynamics. The orders, we have a very large base. I mean, 230,000 crores, and anything to grow on that by very strong numbers is a function of how investments happen in the system around us. I think that will drive the actual outcome as to how much we make. But based on the pipeline that we have and our own assessment that we make every now and then of what is likely to materialize, what is not likely to materialize, we think 10 to 12% seems to be a reasonable bet. I've also taken into account in this guidance that this year could be a little lesser than the 12-month period because of the elections. We do not know, the dates are not yet announced, but it is quite prudent to assume that we may not have the entire 12-month calendar to walk through this year for our plans. It could get truncated depending on the election situation. Because run up to the election, there are periods where I think the priorities of the government changes, and consequently the thrust that has been given over the last 12 to 18 months or even 24 months about ramping up, scaling up projects, awarding more, etc., could take a bit of a breather. That is inbuilt into our assessment. If none of those happens and the elections really is announced in 24-25 and it doesn't affect up to March 24, maybe then the upsides could exist, but we don't know now. Secondly, as far as revenue is concerned, for the same reason of election period, the disruptions that could happen, etc., we have factored in possibly a little bit of a truncated year. And secondly, as I mentioned to you, that the execution of the orders that we have won in 23 will actually happen after about 12 months. The first 6 to 9 months will go in engineering work, the approvals and the clearances. Then the next couple of months will go on procurement, order placement, negotiating with vendors, etc. The actual work on the field will happen in the following year. So, sorry, for 23 order wins, 24-25 would be the year where you will see execution on the ground and hence margin accruals. During engineering and all that procurement, there's no margin that really accrues. Cost gets accumulated, but margins don't accrue. And by then, hopefully, the backlog that I have today of 4 lakh crore has 2 lakh 31 of the current wins and about 1 lakh 70 of the past wins. And this 1 lakh 70 will get washed through the period largely of 24 and partly of 25. But the impact of that, if bulk of it I have sort of absorbed, what is remaining is the tail portion of the old contracts, which is why I feel the first 2 3 quarters, if the margins are soft, they're soft with a reason. And the recovery of margins from Q4 of current year into the following year could possibly get us back to more normal times.
So the upcoming union election, of course, would be a big, big event to watch out for, and rightfully so. Mr. Raman, if I were to look at your current order inflows, a substantial chunk of your orders are actually coming from government-backed orders, and like you said, it could be a truncated year this financial year because of the elections. Now, given that backdrop, what is it that you are expecting from the private sector? Are we seeing a pickup in capex, and what are the sectors which you think might be driving growth in this financial year?
Interesting that you speak about it, because statistically, in FY22, we had, of the incremental orders that we won in FY22, we had 26% or thereabouts from private sector. And when I talk about private sector, I am geography neutral. I mean, whether it is India, overseas, and putting it all together. Uh, that number moved up to 32% in FY23. So the year that we just reported, 32% of the projects and the manufacturing business had private sector orders. And it's only the 68% that had government sponsored, whether it's state, center, or PSUs, government sponsored orders. Where is this movement happened? I think one place where the movement has happened is in the area of steel and metals, basically metals, because I think the pricing power the market seems to have appreciated, and they're investing in capacity. So we won fair bit of orders in our minerals and metals business. The second bit is all the airport orders and the station redevelopment orders, etc. They are all maybe government enabled, but executed by private sector. The concessionaires are private sector. So that's the second piece that has moved. The third piece that has moved is automobile industry. In this transition of normal vehicle to EV and stuff like that, a lot of additional add-on investments for additional lines have come in from this sector. And since we have been building automobile plants, etc., some bit of buildings and factories have also benefited from that. The ancillary associated with automobile, the tire making machinery, etc., have also seen a lot of pickup, and we find orders from tire manufacturing for tire manufacturing equipments and businesses pick up. Given the activity that is generally there in the infrastructure space, the construction mining equipment business has picked up, and there are also orders from that sector. For example, we received large orders from companies like the groups like Tata's, Jindal's, etc., which significantly pushed up the ratio for that vertical for private sector orders. Then we look at the whole space of energy transition, the investments that private sector is making, and this you could attribute to possibly the ESG thrust or the general awareness about wanting to be more climate friendly and hence more sustaining, is making people invest in zero water discharge or in effluent treatment or in even energy being renewable energy. These are all happening within the private sector space. Not to say public sector is not interested in this. For example, IOC is making big moves on this green energy. But those are yet to hit the order book. But private sector orders are much smaller and they are quicker on the take. Then finally, the whole space of data centers and healthcare systems. These are two areas where private sector is investing. Hospitals are being built, data centers are being built. The whole issue around data privacy and localization of data, etc., is also making the IT companies pack services on top of the data centers that are being built. And India is, being an IT powerhouse that it is, India becomes a natural space for hyperscalers to look at. So these are the areas that are happening. Commercial real estate is another area for private sector, and we do think with some amount of momentum picking up on working back from office, this will get reject. Companies are now beginning to create capacities in tier 2 towns. Earlier, everybody was focusing on tier 1 because that is where talent was supposedly available. Today, talent has migrated from tier 1 to tier 2. So you have to have enabling infrastructure in tier 2. That is also being done by private sector. So I see, while there is no wholesale jump in private sector capex, incrementally based on the sectors that are engaged in growth, incrementally these investments are happening, and I think this will gather pace over time. We need to be a little more patient because private sector balance sheet, after a lot of effort, has got cleaned up. I don't think they will forget the lessons in a hurry, and they won't go on a big binge on investing in capacities without being sure of the returns that they generate.
I think patience is definitely a virtue for players in the infrastructure sector. Mr. Raman, I know that L&T does this massive exercise at the beginning of every year where you assess the opportunity that is
Yeah.
in the industry. What is the order pipeline looking like for FY 23-24 in the domestic market as well as the international market? Your last quarter has been quite interesting in terms of the orders you have picked up internationally. So give me a sense of what is the order pipeline looking like, how much of the projects are you planning to bid for, and good case scenario, what percentage of that could you win?
We normally look at the pipeline from the perspective of what interests L&T. So the bigger outlayer of what is happening in the overall economy is something that I'm keeping out of this limited conversation. When we looked at what could interest us, the pipeline seemed to suggest something like 10 lakh crore as projects that are likely to come through. Now, these are sectors where we are deeply involved in. Out of this 10 lakh crore, roughly you can take about 35% would be international, 65% would be domestic. Now, let me break this down a little more for you. Now, between this 10 lakh crore, about 6.5 lakh crore is what we assess broadly. I'm just rounding off on a ballpark basis. 6.5 lakh crore would be for infrastructure sector, and this would be across buildings and factories, power transmission, transportation infra, heavy civil, minerals, metals, all of that put together is about 6.5 lakh crore. We do think the energy space, led by hydrocarbon, would see about 2.5 lakh crore. This would be both onshore and offshore of hydrocarbon investment. We expect maybe 60% of this to happen in international markets and only about 40% in the domestic market. Then we think, given the demand for power and the need for the government, particularly in an election year, to make sure that power availability is there, we do think that opportunities in the traditional sources of coal fed or gas fed power plants, there will be one or two opportunities, limited opportunities for us, given that BHEL is a very large competitor, but possibly put together about 30 to 50,000 crores worth of opportunities could exist, including the desulfurization campaign that the country is doing, where all the old rundown power plants are getting refurbished, if I may use the word, for being better, reducing their emissions and pollutants. So I think put together about 50,000 crores is what we see in that space. Between all the rest of the businesses we run, could be another 2 lakh crore. So put together, this 10 lakh crores is what we look at. Normally, when we do this exercise and actually look back and see how we have fared against this pipeline, our win rate has been between 15 and 20%. So we do think out of this 10 lakh crore, about 2 lakh crore could be what could come our way. Now, this obviously excludes the growth in services business. Collectively, between the IT companies, we are today about $5 billion. We expect to keep the growth momentum in that sector. maybe all going well, a 15% growth year on year is something that could happen in that sector, and in good year it could go to 20-22%, as it had happened in 23. In 23 we reported almost a 27% growth. But if you even normalize it to a 20%, averaging between 15 and 27, that could keep us engaged as well. So we do see, on top of the 2,31,000 crores that we have done, we do see about 2,60,000, 2,65,000 crores as potential wins, and that adds up to this 10-12% guidance that we have given.
Mr. Raman, you mentioned the IT business, and that is something that L&T is very keen to kind of, drive in terms of its contribution to the total business. Now, two things: post the merger of L&T Infotech and Mindtree, one of the things that has happened is there have been some high-profile exits from the company. Other than that, if you look at the macro space, a lot of IT majors are being a little cautious about the demand outlook. Given these two things, do you see them as challenges? And how? What is the strategy? If you're saying that 15 to 20% growth is what you're targeting, then what is the strategy to work with these two challenges going on?
See, exit seems to be a way of life for IT world. I don't see a situation, very rarely, that the same team continues for a long length of time. If you typically take, by contrast, L&T, you will have people working for 25, 30, 35 years quite easily, and you don't get that kind of profiling in IT. So IT, our orientation should be to get the right skill pool for a certain projects or set of projects that we are working, and making sure there is no exit midway to create disruption in that project. Secondly, the integration that we attempted between Mindtree and LTI has gone on rather smoothly. I think if you consider a total resource pool of 95,000 people between these two companies, I think the exits that have happened has been a very small number as compared to this. So this is something that we were anticipating, but happy to report that the outcome has been far better than what could have been our worst case scenario in such a situation. As far as growth is concerned, I think all the big players, and we consider ourselves fairly small. I mean, $5 billion at the end of the year, there are companies which do this in 1 quarter. So their assessment of sizing and their assessment of opportunities and delta growth is like our infrastructure growth. Since the base is so large, I think to grow at 20% is a huge task. So these IT companies are possibly having the scale as an issue when it comes to delta percentages. L&T, Infotech, and Mindtree combined being that much smaller and operating in a more nimble fashion at another level of client engagement, we do think that this level of clients have not pushed back on their programs. In fact, whatever business model transition programs that they're working, they have to complete. They can't abandon it midway. What is under question is how much of discretionary spend will they commit themselves going forward. So our sense is, given our base, I think we do see clients possibly remaining engaged with us for this growth that we are talking about. But at the moment, we are too small to really put out a caution saying that, growth has become a concern for us. I think we need to make sure that the opportunities that do not go to the large companies because of whatever filters that they have, we are able to grab and make inroads in those accounts.
Mr. Raman, the other big announcement, of course, was the change in leadership. I mean, your succession plan has been well storied, and we knew this was coming, but just the announcement that Mr. Naik is stepping down after 58 excellent years at L&T, and Mr. Subramanian will take over as chairman in October. That's a big news that people have been closely tracking. Now, this comes at a time when L&T is really initiated its most ambitious 5 year strategic plan, lakh 26, as you call it. You're looking at doubling revenue, you're looking at doubling order inflow, and you're also looking at divesting some of the non-core
Yeah.
assets. Help me understand, how does this work out? I mean, in terms of continuity, in terms of just the challenges that you foresee in this 5-year strategic plan going ahead?
This transition couldn't have been as seamless as it has actually been. I think one of us is actually taken on the larger responsibility. And if you approach it as one of our colleagues have gotten to this important position, and Mr. Nayak's shoes is huge to fill. So that I think everybody concedes. So I think the benefit of doubt in terms of time and evaluating how successful the transition has been will not be so focused on as it would be in case of some external third party coming in and assuming leadership. Here, I think it is just the question of continuing the momentum. Mr. Nayak has provided us a fantastic base, and we couldn't have asked for more. I think it will be our collective job to make sure that we are able to support the vision and the plans of the new leadership and make sure we take the company forward so that we can possibly do to our successes what Mr. Nayak has done to us. So, to that extent, I think this transition was very well planned and has been smoothly executed. Now, coming to the question of Lakshya, I think it was ambitious in 21 when we were just off COVID and we really didn't know whether we have gone enough south in terms of being hit by the pandemic. We still set ourselves that we will double the order inflow, double the revenue, and most importantly, double the ROE. We were at 9% ROE. We said we'll go to 18% ROE. So on the back of all this meant that we have to do things that make our cost competitive, make our technology futuristic, be able to be relevant to the client in terms of execution, and be profitable. And all of this has to be done. The levers for all of this would be to make sure that we are very efficient when it comes to resource utilization, be it men, be it machines, be it money. I think we need to be extremely careful about how we use our resources. Two, we have to take advantage of the fast evolving technology to be able to improve our productivity. Again, the fact that today we can track most of the things that people or machines do enables us to possibly take calls on optimizing the use of resources. And that is something that we should continue to press on, because I think we are just still nibbling at the tip of the iceberg in terms of what potentially we can do to transform the company going forward. Third is we are already completed 2 years of the Lakshya plan, and we are actually bang on in terms of the path so far. The challenge would come in possibly the last 2 years of the plan, where like the slog overs in T20, the asking rate creeps up, and that is where I think we are a year away from having to sort of ascend that final peak, which we are confident if we continue to work the banner we have worked on 23, and we will continue to do things that will improve the margin profile, we should be able to get there. As far as ROE is concerned, I think it's also a function of A, completing the divestments so that the losses that we were booking in our books on account of these infrastructure investments disappear. And B is to make sure, as I spoke to you earlier, the normalcy returns to our core business. Three, scale up our services business, which is most profitable piece of the portfolio that we run. And fourth is to make sure that the extra cash that we have, we are able to share it with the shareholders. Now, the recent dividend declaration of 24 rupees per share has a 43% payout ratio. Now, L&T normally has been paying out at 25-30%. It's not been paying out 40% and thereabouts. We'll continue to do this. We are not looking at the Lakshya period for any big bang investments in terms of acquisition. There would be tuck-in acquisitions, etc., that will happen in the services space. That will continue, but services business are run in a separate listed company's balance sheet. So I don't think L&T's core shareholders need to worry about that. L&T's own growth plans involves normal investment in capex, maybe some investments in this green energy transition and data center, but beyond which I think we don't have much debt to service. So beyond this, if we are able to conclude our Lakshya plan well, I think there is a good opportunity for us to share our fortunes with shareholders.
Would you like to put a number on the capex that you are planning?
About 4,000 crores is what we normally year on year spend on capital expenditure for strategic equipments. maybe a couple of thousand crores for this green energy transition, and maybe a couple of thousand crores for the data center that we are working on. So put together, on the cash that we generate on a year-to-year basis of something like 13,000-14,000 crores, if our working capital is managed as efficiently as we have done so far, I see the debt servicing obligations being very limited. The annual capex can be conveniently met out of this, and then there will be cash to spare.
All right, Mr. Raman, I know you've had a very hectic last few days with the results and announcements. I hope you catch some rest over the weekend, which is around the corner. Always a pleasure talking to you. Thank you so much for your time and perspective, and hope to be in touch with you going ahead as well. Thank you
Thank you
very much.
so, thank you so much. Work is energy, so it's fun as well.